and Finance, Faculty of Social Management Sciences of Achievers University, Professor Adeboye Akanni Akinwunmi. Please, a round of applause for him. Thank you very much. Today, here seated, this particular occasion is being graced by his children, Mr. Adedamola and Mrs. Olamide Ogunsanya. Mrs. Olamide Ogunsanya is the daughter of the inaugural lecturer and is here with his very handsome husband. Of course, the daughter is also very beautiful. We love your attire, very distinguished and unique. Thank you very much for coming. And of course, we have in our midst Mr. Buki and Mrs. Lanre Akinola. They are siblings of the inaugural lecturer. Mrs. Lanre Akinola is the sister of the inaugural lecturer. You're welcome. We also have friends of the inaugural lecturer here seated. We have Dr. Oluwaseye Olayinka. Thank you, sir, for coming. We have Pastor Lekon Fakeye.
Rigorous scholarship and academic excellence. Professor Akinwunmi's scholarly contributions are extensive and impactful. He has published widely in reputable national and international journals, including the Journal of Real Estate Literature, International Journal of Business and Finance Management Research, Asian Business Research, European Journal of Accounting, Auditing and Finance Research, and several other journals. His work has enriched discourse in banking, finance, real estate, and economic development. Today, Professor Adeboye Akinwunmi delivers the 7th Inaugural Lecture of Achievers University. On behalf of the Governing Council, Senate, management, staff, and students at the entire Achievers University. On this note, I invite Professor Adeboye Akinwunmi to deliver the 7th Inaugural Lecture of Achievers University titled Re-Capitalization in the Nigerian Financial System for Whose Benefit. Professor Akinwunmi.
The Acting Vice Chancellor, the Registrar, the University Bossa, the University Librarian, Provost of Colleges, Acting Dean, Faculty of Social Management Sciences, Deans of other faculties, all distinguished professors, other members of the Senate, all academic and administrative staff, great achiever students, invited guests, gentlemen of the print and electronic media, ladies and gentlemen. To God be the glory, the omnipotent God, the author and finisher of our faith. I never knew that a child of a farmer or a peasant farmer could be on the podium this day giving an inaugural lecture as a professor of banking and finance at Achievers University. When I attended the employment interview on Thursday, June 24, 2014, about 12 years down the line, the ambition was about getting employed. I appreciate individuals that have contributed significantly to my developments, spiritually, academically, and socially. I thank the Pro-Chancellor, Professor Olabode Ayorinde, for his vision to have really marshal all the necessary factors of production, talking about entrepreneurship, talking of land, labor, capital, to establish university in December 2007. And academic work commenced in April 2008. Today, Achievers University is having 38 programs. We are having students attracted from about 35, 36 states of the Federation with the FCT. Achiever University is the second largest employer of labor after the Ondo State government in Ondo State. I sincerely appreciate the Acting Vice Chancellor, Professor Oyesoji Aremu, for this opportunity to present the 7th Inaugural Lecture of Achievers University series. This lecture is unique in many aspects. As much as it is the 7th Inaugural Lecture at AUO, this is the third lecture at the Faculty of Social Management and Finance, Achievers University. It is to the name of the Almighty God. What is the essence of an inaugural lecture? An inaugural lecture is a formal academic milestone that celebrates a newly appointed or promoted full professor. It serves as a public introduction to the academic community, giving the opportunity to the scholar to showcase his or her academic outputs and engage with the broader public. Mr. Acting Vice Chancellor, sir, may I respectively submit that this lecture is not merely a personal milestone. It is a public academic conversation on the capital strength, banking stability, credit access, and national development. Let me briefly explain the question. It's not only whether banks are stronger. The question is also who benefits when recapitalization succeeds. Introduction. Acting Vice Chancellor, sir. Academic research is a systematic, evidence-based inquiry that deepens knowledge and supports national development. National development means improving citizens' socio-economic well-being through social amenities, public goods, and enabling economic conditions. It entails sustained growth in productive capacity, technological advancement, and improvement in the standard of living as given by Human Development Report of 2013. Nigeria's development challenges is reflected in low income, poverty, unemployment, inflation, weak savings, low investment, and infrastructural deficit. Akinwunmi and Adeboye 2018. In this context, the financial system becomes strategic because it mobilizes resources, supports investment, and underpins growth. Akinwunmi 2012, Akinwunmi 2022. The theoretical concept of finance. In pecking order theory, it is stated that firms prefer internal resources before external funds. Retained earning comes first, debt comes next, and equity is usually the last. The resource-based view says that it emphasizes the importance of internal resources in achieving sustainable advantage. However, Akinwunmi and Akinola 2019 argue that retained earnings are a key internal source of business growth, but internal funds are often not enough for expansion of large investment. Akinwunmi and Akinola 2019. Akinwunmi and Najala 2020 posited that many entrepreneurs lack sufficient internal funds to undertake capital-intensive and profitable ventures, thereby making external financing inevitable. May I respectively submit, firms begin with internal resources, but expansion pushes them towards debt, and when necessary, equity financing. Debt is usually better to redeployable assets. Equity fits highly specific assets. Williams, 1988. This is why the strength of the financial system matters to investment mobilization and national development. The conceptual background. I'm going to give a brief explanation of what a financial system is. A financial system is an aggregation of institutions, markets, instruments, and regulatory frameworks that facilitate the flow of funds between savers and borrowers, enabling money exchange, risk management, and efficient capital allocation in support of economic activities and national development. Akinwunmi 2012, Oluwaseye 2016, Akinwunmi and Ajala 2018. The major components of a financial system, we are having the financial institution, as I mentioned earlier on in the definition, the deposit money banks, the non-bank financial institutions, the insurance companies, developed finance institutions. When we are talking of financial markets, you are having the money market. They are the short end of the market. We are having the capital stroke, the stock market. They are at the intermediate market. The bond market could really be for 25 years or more than that. When you are talking of financial instruments, we are having the stocks, bonds, mortgage, derivatives. The regulatory authorities that manages the financial system in a country. You are having the Central Bank of Nigeria taking care of the monetary policy. You are having the Ministry of Finance taking care of the fiscal policy. You are having the Security and Exchange Commission taking care of the capital market. And the policy coordination is taken over generally by the government. Deposit money banks are the backbone of the financial system, mobilizing savings and providing credit. They connect savers with investors, support trade, and derive economic activities. In Nigeria, banks play a strategic role in growth, investment, and financial inclusion. Akinwunmi et al., 2012. We look at recapitalization concept and mechanism. Recapitalization refers to the process of strengthening the capital base of financial institutions to enhance stability, resilience, and capacity to deliver financial intermediation services. In Nigeria, recapitalization has been a recurrent policy instrument in banking reforms, most notably in 2024 to 2025. And in subsequent regulatory cycles, Shanusi 2011, Ayorinde 2018. The strategic objectives of recapitalization. It seeks to enhance the buffer to absorb unexpected operational or credit losses. It strengthens the capacity to mobilize deposit and extend credit to the real sector. It provides psychological and financial assurance to the public and reducing the contagion risk of bank failure. In an attempt to look at the recapitalization concept, we are having the graph showing the recapitalization has been taking place in the last few years, 1952. You look at it before before 2004. You look at 2004 to 2005. Then you look at the current regulatory cycle. So in that particular graph gives a historical context of capitalization as a recurrent policy. Acting Vice Chancellor, sir, capital adequacy requirements significantly influence bank behavior in at least two important ways. First, strong capital improves resilience to economic shocks, and it limits excessive risk exposure. Second, a sound capital base strengthens banking performance and financial stability. Three major ways of identifying through which a sound capital base strengthens banking institutions. It absorbs unexpected losses while maintaining solvency and competitiveness. It strengthens the liquidity confidence and reduces vulnerability to sudden deposit withdrawals. It promotes risk taken by discouraging excessive exposure and risky behavior. Akinwunmi 2009, Akinwunmi et al. 2012, Akinwunmi and Ajala 2020, Akinwunmi and Dari 2022. The Nigerian recapitalization reforms align with global banking standards, but they must also reflect the country's commodity dependence, exchange rate volatility, and developmental financing needs to support both stability and growth. OG et al. 2015. The capital structure of any organization as shown, figure 2 to 5, we give a pictorial view that when you have a capital structure with 100% equity, you compare it with capital structure with 75% equity. The difference between figure 2 and figure 3 is the fact that when you are having equity capital of 100%, you are not really paying any interest. But when you are having capital structure 75% equity and 25% in debt, you pay 25% interest on that debt. So meaning that figure 3, as is shown, that organization will not have the same profitability level with what we are having in figure 2, and it continues to figure 5. Let's move. We decided to go to the roots of financial intermediation, the traditional saving culture compared to what we are having. Under that figure 7, you could see the first picture there, we call it Ajo Isusu, which is one of the traditional way of really saving money. You look at Kolo, the way our elders discipline themselves by dropping some money to meet a particular target. That is what we are having in the middle. Then on the top, we are having the cooperative society. Before we go into the OP and the other deposit money banks, what is so interesting about this traditional way is that nobody is asking you for any security before lending is undertaken. It's basically your relationship within the society. So there is no basis you can really take money from any of these Ajo or Isusu people that you think you can really disappear. One way or the other, you have to pay the money back. Then early banking capital requirements. Acting Vice Chancellor, sir. The shift from informal savings to formal banking reflects the gradual strengthening of the Nigerian financial system. Akinwunmi 2009, Akinwunmi et al. 2012. Then the major reforms we had in 1988 to 2003 reform milestone. You look at the period, 1988, indigenous and foreign dichotomy abducted. You have, if you want to start a merchant bank, you have 6 million. Commercial bank is 10 million. Then in 1991, under the Bofia Act, you are having the merchant bank 40 million to start their business and 50 million to start a commercial bank. CBN first uniform minimum deadline, 1998. All the banks, whether merchant bank or commercial bank, they were required to have deposit of the capital base of 500 million. And in 2003, the final review before major consolidation was moved to 2 billion. It was highlighted in Ayori Day 2018, discussing about banking reform in Nigeria. He mentioned specifically that this progressive adjustment reflected inflationary pressures and need stronger financial intermediation during the deregulation era. In 2004-2005 to 2005 consolidation exercise, the specification of the central bank was that banks, whether commercial or merchant, should have a minimum deposit of 25 billion. Despite the fact that Nigeria was having almost 90 banks in the financial system then, a lot of the banks, industry, shipping, and impact, a lot of the banks could not meet up the 25 billion, and 64 banks surrendered their licenses due to the inability to comply with the required 25 billion. So operational shift. It forced mandatory mergers and aggressive recapitalization. If you can recollect, that was the time you have banks like National Bank merged with other banks. You are having Prudent Bank merged with other banks. And At the end of the day, we were having 64 banks. The resilience, it aimed to transform the sector into a global competitive engine. The condition of the era, the 2005 reform remains the most significant regulatory watershed in Nigerian banking, prioritizing solvency over institutional volume. The increment in minimum capital requirement rose from 100% before 2003-2004 to 2,500% in 2004-2005. Then we are having the current recapitalization framework. The Central Bank of Nigeria introduced a new recapitalization framework to address macroeconomic pressure, currency depreciation, inflation, and global regulatory demands. Effective from April 1st, 2024 to March 31st, 2026. The bank category, where you are having commercial regional banks, the minimum capital is supposed to be 50 billion. Commercial national banks supposed to have a minimum capital of 200 billion. Then commercial international bank, that will be a bank registered in Nigeria, but is operating outside the Nigeria boundaries. We must have a capital of 500 billion. That is where we are having banks like First Bank, you are having Zenith Bank, Access Bank, and Guarantee Trust. The revised framework significantly depart from the earlier exercises by defining the qualifying capital more narrowly as paid-up capital and share premium only, excluding retained earning and certain reserves previously admissible under the 2004 exercises. In complying with these policies, banks are expected to comply through the one or a combination of the following strategies: fresh equity injection, right issues, private placement, mergers and acquisition, license upgrade or downgrade. So if you are formerly a regional bank, you can move to national bank, you can move to international bank. If you have been an international bank, if you cannot meet the requirements, you downgrade to either national or regional bank. What is the policy implication? The current recapitalization policy is intended to strengthen operational resilience, improve risk absorption capacity, enhance investors' confidence, and reposition Nigeria banks to a larger financing level. However, the policy has also raised concerns regarding compliance pressures on smaller banks, possible market concentration, and the implication for SME financing and financial inclusion. Thus, while recapitalization remains a necessary instrument for banking sector stability, its broader development implications raise an important policy question: for whose benefit is recapitalization ultimately designed? Reform and liberalization. Banking reforms have been implemented across Europe, Asia, Latin America, and Africa over time. Akinwunmi 2009, Akinwunmi et al. 2012, Akinwunmi and Dari 2022. In Nigeria, the Central Bank of Nigeria has introduced several reforms to strengthen the banking industry and improve financial inclusion. IORIND 2018. Reform effects were implemented through establishment and approval of the following: the People's Bank, the Rural Banking Scheme, the Community Banking, Universal Banks, Development Financial Institutions, Savings Companies, Microfinance Bank, Government Enterprises Employment Program, GEP, IORIND 2018. Such reforms are important because banks perform three functions. They support its payment system, they transform borrowers' claims into inevitable financial instruments, they help in evaluating pricing and monitoring credit allocation in the economy. Empirical evidence, trying to look at what we call real assets and financial assets. Real assets are essentially for business operation, which include tangible assets such as plant, machinery, buildings, and furniture, as well as intangible assets such as patents, copyrights, technical know-how, and technological collaboration. In contrast, financial assets comprise securities and financial instruments such as shares, bonds, leases, and borrowing obtained from banking and non-banking institutions. Pande 2011, Akinwunmi 2012, and Akinwunmi and Ajala 2020. For most households, housing represents the largest real asset and a major store of wealth. Akinwunmi 2009, Akinwunmi 2012. Nigeria faces a severe housing deficit driven by rapid urbanization, population, and rising construction costs, leaving many citizens in substandard housing and or without homes. Then I'm looking at the constraint to housing acquisition. This study identifies funding constraints, regulatory requirements, collateral demands, repayment capacity, and loan tenure as major barrier to housing acquisition. It further established that housing finance depends on two factors: the ability of financial institutions to lend and their willingness to lend. Housing finance depends much on what is available. Mortgage access is rationed by a chain of constraints. When you look at the bank side constraints, the equity base of a bank, that is their capital, determine the quantum of lending they can undertake. The deposit structure in Nigeria, mostly the deposit structure of most of the banks are dominated by demand deposits. Those are the funds you can withdraw without any notice. You get your salary of 200,000, you withdraw 195,000. You are having only 5,000 left in your bank account. So this short-term deposit could not be used to lend on a longer basis. We are having the reserve ratios as requested by the Central Bank of Nigeria. The interest rate is an issue, and then the competition. Then from the side of the borrower, is the borrower having the collateral to provide for the banks? That's the reason why we are having security and the collateral. The income of the borrower. You look at it that a borrower earning money is not supposed to pay more than one third of his salary as loan repayment. But when you are going to get a larger quantum of loan, you see some people paying about 80% of their salary as repayment of loan. So that type of loan might not really be something worthwhile for the bank. What are the core ideas, the theoretical model of lending behavior? The core ideas from this theory: banks allocated assets by balancing risk, return, and liability structure. Liquidity and capital market conditions shape how far banks can extend long-term credit. Risk-averse banks prefer assets with lower default rates even when returns are lower. Again, you look at the model, you are having the dependent variable, which is the housing finance supply, and then the independent variables, like I mentioned earlier on. You see the share capital and reserves. You see the deposit liability and other liabilities. You look at the sectorial lending as specified by the Central Bank of Nigeria. You look at the total investment. You know, the banks invest in treasury bill and government bonds as requested in the liquidity ratio specified by the Central Bank of Nigeria. Then the third aspect of it is the cash reserve requirement. Here, the Central Bank requests banks to keep 50% of their deposit as savings at the Central Bank of Nigeria. This limits the lending ability of majority of the banks, which we believe if this is allowed to go down, it can stimulate the economy if they are allowed to lend. We have in NDIC 2005, Akinwunmi 2009, and then Akinwunmi 2012. Looking at the implication for recapitalization, there are two ways you can look at it. You look at the stability aspect, you look at the development aspect. Stability in the sense that you believe that the banks are having adequate capital to run their business, to improve prudential buffer, to have stronger liquidity position, to have greater investors' confidence. But for developmental purposes, recapitalization automatically increasing housing finance supply. Banks still prefer liquid financial assets like treasury bill. They want to lend to commerce where the money can be paid back within a very short time. Without policy incentive, strong banks might simply hold more government securities rather than lending to the productive sector of the economy. Household and SME may see little direct benefits. Akinwunmi 2009, Akinwunmi and Dari 2022. Now to the question, recapitalization, who benefits? Acting Vice Chancellor, let me now address the central question of this lecture. Based on this evidence, three groups stand to gain more directly from recapitalization reform. The large banks, they are having strong bank. Okay, the strong bank easily meet recapitalization threshold. They gain investors' confidence, stronger market reputation, and better liquidity. I'm still referring to banks like First Bank, like Access Bank, like Zenith Bank, and Guaranty Trust Bank. The regulators, as represented by the Central Bank of Nigeria, recapitalization strengthens bank stability and lowers risk. It improves confidence in banks' ability to withstand shocks. It helps build a stronger, more competitive, and more credible banking sector. To the investors, stronger banks attract more investors and face lower perceived risk. They enjoy better share performance, higher valuation, and stronger dividend potential. Mr. Vice Chancellor, sir, may I respectively submit that the benefits of recapitalization are not evenly distributed. 4 vulnerable stakeholder groups may face restricted or even negative consequences. The small and medium-scale enterprises, they contribute over 50% to the GDP of this country, but can they benefit from this recapitalization? Banks focus on secure clients and safer assets. The risk is that it's having tighter risk analysis and it limits financing. So, facilities are restricted from them. The smaller banks, they are forced into going to extinction, or in the other way, they can be forced to merge with another organization they might not really have the same vision with. And the key risk is that they have loss of autonomy, then operational identity is lost. The rural customers, post-merger branch dispute can come because we are having 2 strangers coming to do business together. It might not really be easy. So the issue of financial exclusion worsened, digital divide persists. Then the mortgage kickers, banks, shall prefer liquid assets more than mortgages. Acting Vice Chancellor, sir, my contribution to knowledge. I've been involved in active research focusing on solving real-world problems through a continuous circle of action and reflection, highlighting key challenges that must be addressed to improve financial intermediation and credit expansion, 2009. In the process of doing this, a conceptual framework was developed for bank stability in the emerging economy, and it is addressed as SFAF, Stable Microeconomic, Financial Development, Advanced Technology, combined together. You say that stable microeconomic condition, that particular sector of the framework, look at it that the GDP, the foreign direct investment, cash reserve requirement have a negative effect on the stable microeconomic condition. Look at financial development and liberalization. In Nigeria, the depth of our financial market is not so broad, and we are having a lot of problems there. Then advances in information technology. When we look at some banks, look back in the last 10 years, majority of the banks that are making hay today in the Nigerian financial system, you are having the Access Bank, you are having Guarantee Trust, Zenith Bank. They were the first set of banks in Nigeria that introduced technology into banking operations. And today, they are really in a better position. There is a strong long-run link between GDP, NPR, foreign direct investment, external reserves, where stronger economic performance attracts FDI and enhances reserves and lending capacity. Akinwunmi and Ajala 2016. So advances in information technology, we have seen that artificial intelligence being applied to banks generally in form of machine learning, you're having predictive analytic, then in process automation, you are having streamlined operations, it reduces repetitive tasks. Then the credit scoring, majority of our small-scale enterprises, the risk attached to lending to them is very difficult. So machine learning has now started using their system to classify borrowers' risk. And an extensive study was done by Akinwunmi and Dari in 2022. Blockchain is a security payment mechanism which strengthens risk and reduces default in the banking system. In Nigerian system, to monitor the risk in lending, the credit bureaus they are coming up, and banks are coming together to make sure that they can really assess their customer when they are really asking. As Akinwunmi and Dari 2022, machine learning algorithm effectively classify new borrowers into risk categories, random forest, gradient boosting, among the best performers using LAPO MFB. The study, AI in customer satisfaction and loyalty. The study was premised on the fact that artificial intelligence could be deployed in improving customer satisfaction and customer loyalty. The tools, AI tools deployed include chatbot, virtual assistant, predictive analysis, fraud detection systems, personalized financial guidance. And then for customer satisfaction, artificial intelligence deployment significantly enhances customer experience. Akinwunmi et al. 2026. Then, on this basis, looking at the information infrastructure and lending approach, you look at the differences between transaction-based lending and relationship-based lending. In transaction-based lending, you look at information sourced from financial statements, asset ownership records, credit scoring system, public registry, private credit bureau. But in relationship-based lending remains the dominant financing approach in developing countries. You know your customer. Long-term lender-borrower relationship improve information monitoring and credit assessment. It helps reduce information asymmetry and improve lending decision. Acting Vice Chancellor, sir, looking at recapitalization in the capital market, let me draw your attention to the development reported in the Guardian Monday, 19 January 2026, page 6, under the headline, Sex New Capital Stir Anxiety. Stress test portfolio managers. May I respectively submit that the capital market is not immune to recapitalization waves. The observations made, minimum capital threshold in the capital market might lead into top fund managers hold at least 5 billion capital with stricter rules for larger firms. Market concentration risk. Smaller operators may struggle to survive, which could leave the market dominated by few large firms. The view from this study, policymakers should balance stability with inclusive growth, or the market may become less competitive and less diverse. My research focus on machine learning, investment analysis, corporate finance, artificial intelligence. Okay, next. In conclusion, out of 5.731 trillions of total currency in circulation as of January 2026, 5.21 trillion, that is about 91% of this deposit, they were outside the banking system. Only 350 billion, which is about 7% of the currency, is within the banking system. This is driven by the preference for cash in the informal sector of the economy, due to lack of trust in the formal sector. Is there any justification for the monetary authorities to be chasing the recapitalization because of 350 billion out of 5.73 trillion? As good as capitalization might be, recapitalization is not without its limitation. Older and more established banks process extensive network to mobilize capital and consolidate market dominance. The new generation banks are struggling to meet regulatory requirements in terms of cash reserve requirement and liquidity ratio, who leads to reduced competition and potential concentration within the sector. Recapitalization do not guarantee improved efficiency and ethical conduct, because without sound corporate governance, prudent risk management, and effective supervision, increased capital may not translate into improved performance. Postulate that sustainable reform requires a holistic approach that integrates capitalization with transparency, accountability, and technological modernization. Policymakers must calibrate capital requirements carefully to balance financial stability with inclusive growth. Recommendation for public policy option. The volume of currency outside the banking system is a key indicator of informal economic activity and lack of trust in the financial institution. The continuous holding of currency outside the banking system may be associated with financial exclusion, limited digital literacy, uneven internet connectivity, particularly in the rural areas, might hinder the wider adoption of digital payment system. In Nigeria, the informal sector dominates the economy, accounting for 92 to 93% of the total employment as of 2024-2025, and the formal sector contributes only a small percentage of the workforce. Thus, vast household economy drive roughly 50% to 60% of Nigerian GDP, and characterized by low productivity, vulnerable, and limited access to social protection. Cash reserve requirement is a percentage of total deposit that banks must hold as reserve with the Central Bank of Nigeria, which is considered as potent, though blunt, tool of monetary policy in developing countries. As a direct liquidity control, it is a powerful contraction tool covering the multiplier effect and restrict credit creation. Discrete CRR widens this gap between deposit ratio and lending ratio, which makes it more expensive for private sector to borrow and contributing to overall economic growth. Rather than having rigid 50% cash reserve requirement, the government can make it variable by changing the rate quarterly or half-yearly, which ultimately affects the ineffectiveness of CRR as eroded by the financial innovation. Acknowledgement. To God be the glory, the omnipotent, the author and finisher of our faith. I have a favorite verse in the Bible. The book of Lamentation, Jeremiah chapter 3, says, "This I recall to my mind, therefore, that I hope it is of the Lord's mercies that we are not consumed, but compassion fail not. They are new every morning. Great is thy faithfulness." Acknowledgement to the Pro-Chancellor and the Governing Council members of the university, the Pro-Chancellor and the Chairman of the Governing Council. I will continue appreciating your steadfastness in human capital development with your vision in getting the university license, resulting in my promotion to be a professor in banking and finance. Congratulations on the successful full accreditation of the medical program by the Nigerian Medical and Dental Council of Nigeria. Thereafter, other 7 programs of the university got full accreditation from the exercises conducted by the National University Contribution. I thank the council, the vice chancellor, and management of the university for granting approval for me to deliver this lecture. I appreciate Professor Oye Soja, the acting vice chancellor, VC on extended leave, Achievers University Owo. I appreciate your support and mentorship in the process of taking me to the peak of my career. The Pro-Chancellor and the Vice Chancellor, they traveled all the way from Owo to Lagos to attend the wedding of my daughter. I really appreciate that gesture, and I will continue praising them for what they have done. Thank you, sirs. Thank you, ma. Professor Paul Olomolaye, the Pro Vice Chancellor and the Executive Dean, Faculty of Environment and Technology, University of West England, Bristol. Thank you for changing my life trajectory for good. The end justified the means. Professor Fayeye, you had the trust in me, and you contributed significantly to my academic development. The Senate, Achievers University, or it is joyful to be part of Achievers University Senate, which is the highest academic authority responsible for regulating teaching, research, and academic policy. The Faculty of Social and Management Sciences, I'm expressing my appreciation to all heads of department and staff, academic and non-teaching, for hard work and cooperation when I held the position of deanship between November 2023 and December 2025. It is gratifying to note that together we got full accreditation for all our programs due to reaccreditation, and we won the maiden edition of the college faculty rating for 2024-2025 academic session. Let's keep the flag flying and support the acting dean to go higher, higher, and higher. Congratulations to the Department of Accounting and Business Administration for producing the first set of PhD holders. It is interesting. You can see the Faculty of Social Management Sciences in their regalia. I could look at my good friend, Bola Olayiwola, Dean of Pharmacy, a professor of clinical pharmacy. I call him Bassman. He will join the septuagenarian on, I think, on the 15th of June. We will be there to celebrate with you. You are an academic mentor and an individual with listening ears. Despite the fact that we met about a year ago, you have taken the responsibility for this inaugural lecture as if we have been together for decades. You are blessed. And I will not take the relationship for granted. Happy 70th birthday in advance. My Kabiyesi from my village or my area, Yewa, they believe that Owo is so far for them. So the Kabiyesis, I appreciate they are being represented. The Olu of Ilaro and paramount ruler of Yewa land, the Aboro of Ibeshe, Oba Joel Bangboshe, Sophia Olatunji Akinwunmi Bale of Araromi Ibeshe, Ogun State. I thank you all for being, maybe they are watching it online, so I thank them for that. Okay, to my family, my deepest appreciation to my wife, Mrs. Gbemisola Akinwunmi, Mama Olamide. For health reasons, she cannot really be with us. But I thank her for her patience, understanding, and sacrifice that made me today to make today a world life event. My baby, Olamide Oluwagbemileke, and Adedamola Ogunsoya. Just stand down for recognition. You drag everybody from Achievers University to Lagos. So I'm happy you are here today and just to represent Mommy. Thank you very much for being here. My immediate junior sister and the husband, Mr. and Mrs. Akinola, all the way from Lagos, you are welcome. I really appreciate you. Then, unfortunately, with Honorable Prince Kehinde Adeboye Ogunsoya also, I thank you for the relationship we have built over a very long time. And for one reason or the other, he couldn't be here. Pastor Olalekan Fakeye and family. As family members, we have been together. I can't remember whether you were my squatter at Unilag or I was your squatter. So I know you have really done. Okay, we have really done it, and I thank God for everything. Pastor Olufemi Kolajo, thank you. The support and presence of BBHS 6872, thank you very much. Members of Island Club, I thank you. University of Wolverhampton Alumni and Association Nigerian branch, thank you. I'm grateful to individuals that have really built my career in Achievers University. I welcome all my students that are really here. We met during the bridge program, AU Fab. We have done something, full-time BSc program. We did something, MSc. You are welcome. Thank you very much for your support. God bless you all. Thank you.
Thank you so much. On behalf of management of Achievers University, we want to honor the 7th inaugural lecturer of this university, the adult professor, Professor Adeboye Akanni, Akinwunmi, for this recognition. Thank you so much. God bless you, sir. Thank you.
Shall we rise? Achievers Anthem and the university, Achievers Anthem followed by Kindly remain standing as the procession, we take the recession. The academic recession led by the inaugural lecture of today, the 7th Inaugural of Achievers University, Professor Adeboye Akanni, Akinwunmi, just delivered the 7th inaugural lecture. Thank you very much for coming. In our midst today, we have the Pro-Chancellor, the Vice-Chancellor, professors from the Faculty of Social Management Sciences, and distinguished professors from other faculties. Thank you very much. Thank you very much. Our students, thank you very much. And we can see the beautiful dress that the faculty